every Monday to Friday. This is Peter Lewis's Money Talk. Money Talk.
Good morning, it's Fed Day, Thursday the 2nd of November. This is Peter Lewis welcoming you to my podcast Money Talk, where today we'll be bringing you analysis of the Fed's latest monetary policy meeting. That's coming up. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. And thank you for making us one of the most listened to financial podcasts in Hong Kong. In today's business and finance headlines, the US Federal Reserve on Wednesday unanimously agreed to hold the federal funds rate in a target range between 5.25% to 5.5%, where it's been since July, but kept open the possibility of additional monetary tightening amid mounting evidence the US economy remains strong. This was the second consecutive meeting that the FOMC left interest rates on hold, following a string of 11 rate hikes, including 4 this year, and the Fed also upgraded its forecast for US economic growth. The US Treasury Department is slowing the pace at which it issues longer-dated debt, following a steep rise in borrowing costs. The move follows an announcement on Monday from the US Treasury that it expects to borrow $776 billion in the October to December quarter, although that is less than the $852 billion initially forecast and lower than the $1 trillion borrowed the previous quarter. The Treasury said on Wednesday that it would continue to increase issuance of shorter-dated notes at the pace it set 3 months ago, while slowing the pace of 10 and 30-year bond issues. China's manufacturing activity contracted in October, according to a closely watched private gauge. The Caixin China General Manufacturing PMI fell to 49.5 in October from 50.6 in September, missing market forecasts of 50.8. This was the first contraction in factory activity since July, amid a renewed fall in output, suggesting the economic recovery remains fragile. Retail sales in Hong Kong increased 10.1% year-on-year in September in volume terms, slowing from an 11% rise in the previous month, and this was the smallest gain since January. On a monthly basis, retail sales decreased 2% in September, slipping further from a revised 1.6% drop in August. On a value basis, sales increased 13%, marking a 10th consecutive month of growth. This morning, I'm joined by Andrew Freris, the CEO of Econosis Advisory, and Hao Hong, Chief Economist at Grow Investment Group. And with a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks rallied on the first day of November following 3 consecutive months of declines after the Federal Reserve kept interest rates unchanged for a second consecutive time. The S&P 500 climbed 1.1% to 4,238, briefly crossing its 200-day moving average. The Dow advanced 222 points, or 0.7% to 33,275, and the Nasdaq Composite added 1.6% to 13,061, boosted by semiconductor stocks. Advanced Micro Devices surged 9.7%, while Micron Technology and Nvidia shares both added 3.8%. US Treasury yields saw their biggest daily fall since March following the Fed announcement. The 2-year Treasury yield, which moves with interest rate expectations, dropped 14 basis points to 4.95%, its lowest level in 3 weeks. The yield on the 10-year Treasury note extended Wednesday's decline, dropping 19 basis points to a 2-week low of 4.73%. The yield on the 10-year Japanese government bond touched a fresh decade high of 0.97% on Wednesday. And the yen rose on Wednesday, as Japanese officials reiterated that they were prepared to intervene to defend the currency if needed. The currency gained 1/3% to trade at 151.33 against the dollar in Tokyo on Wednesday. In US trading, it strengthened further to 150.9 yen per dollar. Elsewhere in the currency markets, the US dollar index was little changed at 106.65. In Shanghai, the yuan was unchanged at 7.31 3/4 of a renminbi against the dollar. On the mainland, the Shanghai Composite Index was up 0.1% at 3,023. The index fell 2.9% in October. Hong Kong stocks oscillated around the unchanged line. The Hang Seng fell 11 points to 17,102. That's close to a one-year low. The city's benchmark index dropped 3.9% last month, its third straight monthly loss, as overseas investors continue to offload Chinese stocks for a record third consecutive month in October. And futures markets are pointing to the Hang Seng starting the day unchanged around 17,100. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
On this Thursday morning, we have with us our regular commentator, Andrew Freris, the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning.
And also with us, we welcome Hal Hong, Chief Economist at Grow Investment Group. Good morning to you, Hal.
Morning, Peter.
The US Fed on Wednesday unanimously agreed to hold the federal funds rate in a target range between 5.25% to 5.5%. That's where it's been since July, but it did keep open the possibility of further monetary tightening. This was the second consecutive meeting that the Fed has left interest rates on hold, and including 4 times now so far this year. It also upgraded its forecast for US economic growth, said it expanded at a strong pace compared with the solid clip it described the economy as moving in September. It also noted that employment gains have moderated since earlier in the year but remain strong. Start with you, Andrew. What are your thoughts, first of all? I think no surprise, is there, that rates were unchanged, but do you think we're at the peak yet?
Depends whose commentator take away from the Fed you read. In fact, the Bloomberg more or less implies that we are almost reached the top. Now, never mind what the Bloomberg says. Looking at the numbers, I'm a little bit reluctant of saying we're at the top, because Powell keeps saying we're not anywhere near on the macroeconomic environment that's going to give us a 2% long-term stable CPI inflation. And in fact, the CPE, which apparently the Fed likes, it is still very, very firmly ensconced on the 3% level. It has come down a little bit. So I just can't see that we have reached the peak, unless and if the macro numbers, and particularly the inflation numbers, are not the kind of thing that will assure the Fed. Now, bluntly, if I was the Fed, I would want to see at least 3 months of flat inflation rates for me to even decide, okay, forget about the 2%. I think we hit a 3% and we're going to stay there. But they're not anywhere near that. I haven't heard anything from Powell saying perhaps the 2% is a little bit too ambitious or a little bit too harsh. And in fact, if we hit a 3% flat, that is going to be okay. So my answer is no, I don't think we have reached the peak for a number of hazy reasons.
Hal, what's your analysis? Do you think we're there yet, or do you think maybe there's more to come?
Yeah, well, I think even if we are at closer to the peak of this interest rate cycle, it's going to be a little tricky for the Fed to bring down the interest rate, because the U.S. numbers are very strong, right? So I think that's one of the reasons why Powell is leaving the door open for further hikes. So if the numbers continue to be strong and the inflation momentum seems to be coming down, but still, lingering at a relatively high level, it will be, a little tricky for the Fed to bring it down. So, I would say that, if we say that it's closer to the end of the hiking cycle than the beginning, then I think most people will agree. And also, even if you want to hike it a little bit further from here, it's like 25 basis points from here. It's not going to make a decision difference for most people. So I would say that, going forward, the Fed's decision, it may not be the key driving factor going forward unless the economic data surprise on the upside or downside.
Let me ask you both. Obviously, the economic data has been strong. We saw that third quarter GDP number. But if you look into things, are you seeing the first signs that maybe the economy is slowing? I'm wondering if you look at things, for example, like the unemployment rate, although it is low, it is trending higher now. We are seeing layoffs in certain sectors, in financial firms and technology firms. We're seeing layoffs. So I'm wondering if that's maybe going to spread to other sectors. Do you think, both of you, maybe Andrew, you could start, are there signs out there that maybe now this is starting to bite and the economy is slowing now?
It's a coward's last resort when you look at the United States, and that is to look at non-agricultural manufacturing numbers and the increases. And these have been quite strong, but sort of they can be quite volatile. Volatile not in the sense that they're all over the place, but they may not give you a very sustainable upturn. I suspect that the Fed may stick to the easy part, and that is simply to look at inflation, which is the consequence of the underlying strength of the economy rather than the reason, rather than play around with numbers that might not be that reliable. So I stick to my idea, yes, that labor markets are important, but I would suspect that the emphasis of Powell, we're not anywhere near yet the 2% level, sticks in fact to the shiny light, the 2% inflation rate. Okay.
What do you think? Are you seeing signs of a slowdown at all out there?
Well, I think to add to that, the manufacturing sector is clearly slowing down. I think the manufacturing sector around the world, including Germany and also China, is slowing down. And I think the developed world's manufacturing sector is actually in deep recession if you look at the PMI number, right? So there's no argument about that. But then the service sector remains very strong, especially in the US. I think this is probably one of the few cycles where we're seeing, we're so far into the cycle, probably towards, the second half or even well into the second half of the economic cycle. But I think, unemployment remain relatively low. And also, if you look at last night's job number, the ADP number is actually surprised on the upside as well. So even though I think the momentum of job creation is slowing, obviously, because, we're so further into the sector. But then at the same time, you can't say that, the service sector, especially in the US, is slowing down dramatically. And also on the other hand, if you look at the fiscal deficit, right? So this year is well above 8%. And I think going into next year, the election year, it would be difficult for the incumbent party to bring down the government spending, right? So I think fiscal deficit will remain well above 6% next year. So that way, if you put everything together, it would point to the path of higher and longer interest rate for the U.S. So I would say that even though the inflation momentum is slowing down, but I think overall the U.S. economy remains relatively strong, especially when you only look at the service sectors.
Let me ask you a bit more about the deficit. Because we had the announcement from the Treasury Department, which maybe is more important than what the Fed did about its borrowing requirements. It's going to borrow less than it did last quarter. It says it needs about $776 billion. It borrowed $1 trillion last quarter. So this was lower than what Wall Street was expecting. And it's going to switch how it funds that into shorter dated notes while slowing the pace of 10 and 30-year bond issues simply because the yields have gone up so much there. But Andrew, do you think this is going to be an important thing to watch going forward, the deficit, how it's going to be funded, and is the size of that deficit, which is going to be about $1.7 trillion this year, is this going to be an important factor?
There are two things here. The deficit might have been quite good in inverted commas, as a silent stealth kind of interest rate policy tool for the Fed. The Fed has nothing to do with the deficit, of course. Okay, this is completely a political decision, because it pushed and kept long-term yields up. All right. So now it might begin to be much, much more important as should inflation begins to flatten out, that and therefore the Fed feels much more comfortable with not increasing interest rates, or even, God forbid, clear its throat and say we may even cut interest rates if the deficit keeps long-term interest rates up. Remember, we said that the deficit is actually doing the Fed's business. So the Fed can go away and long-term yields will stay up because Biden and his friends keep spending. So it is a tricky balancing effect. And I suspect it's going to become much more important. Okay, let's put it like that. If inflation begins to come down or stay flat for the next 3 months, then I think the deficit will become much, much more important as a potential brake to what the Fed is trying to do, to the extent that interest rates will be kept high, despite the fact that the Fed might feel more comfortable now as where we are. Why? Because the deficit will keep long-term interest rates, which they are not policy rates, high.
Okay. How I want to switch to China because we've had a lot of data out this week. We had yesterday the Caixin PMI survey. The manufacturing PMI fell into contraction, 49.5 and 50.6 in September. Missed market forecasts, which were around 50.8. First time it's been in contraction since July. Foreign sales declined for the fourth month. Buying levels fell for the first time since July. Employment shrank the most in 5 months. How worrying is this? Because these are SMEs, aren't they, who participate in this survey, which is crucial, of course, to job creation in China. How worrying is this?
Yeah, well, the SMEs create 60-70% of China's jobs, so it's a very important sector. I think, the number was slightly below expectation was because, for 1/3 of October, the entire China was on holiday, right? So there was a Mid-Autumn Festival and then the National Day Festival for well over a week. So therefore, people are basically, staying at home and all that, and they're not working much. So I would say that, we're going to see a stronger service PMI than the manufacturing PMI later today. And also, if you look at the subcomponent of the PMI, the new order index, which has been expanding for a couple of months now, starting to shrink. But I would say that, that is also due to the holiday effect as well. So I think, this year, the seasonality is stronger than previous years. And therefore, we'll see a surprising or a small surprise in terms of the October PMI reading. So I wouldn't be too concerned about that. Reason being, China just announced a special bond issuance of 1 trillion yuan, and it's very rare that China actually increased the budget deficit in the fourth quarter of this year. Part of the 1 trillion yuan special bonds will go into next year to support next year's growth. So I think 5% for this year is largely in the bag. Unless something unforeseeable happens. And I think going into the next year, the management seems to be quite confident about next year's growth outlook as well.
Andrew, what are your thoughts on this? Does the economic recovery, does it look fragile when you look at this data?
Actually, surprisingly enough, I'm taking a very tangential approach to that because that I'm not a great fan of PMI numbers, and particularly when they move at glacial few basis points, few tens of basis points, it's either way. In other words, it's not a collapse below 50 to say, oh God, here comes a recession. I was much more interested in the 2-year conference that just finished, reviewing the state of the financial system and in particular local authorities' debt, and the fact that Xi attended that meeting, and the fact that very consistently with economic policy making in China, they declared that this is a major problem, and the solution to that is to make quite sure that the Communist Party is more in control than ever over this. And the fact that the People's Bank of China is going to be brought under the 2 new regulatory bodies. I don't even know we don't perhaps even know the names yet. And you might tell me, hang on a minute, what does this tell you? It's telling you that the authorities are much more concerned about the finances right now, rather than individual bits of the economy increasing or decreasing. And politically speaking, as I said, this is very consistent with Chinese policymaking. If anything else fails, you bring in the Communist Party. But if I was there, I would say, please make quite sure that we don't take over as a party the responsibility of sorting out debt in case it turns out to be much more difficult and we end up with a huge poison chalice to drink, as opposed to washing our hands and blaming it all on the local authorities. But the decision has been made, and once again, Xi goes the way consistently and very predictably has done, and that is to tighten control through the supervision of the Communist Party. So I'm playing it in 2 ways, in the sense that perhaps it's not a very good idea to take the blame, on the Communist Party for trying to sort out the local authorities' debt. But on the other hand, this is very consistent with Chinese policymaking. So in other words, this is not meant to be a criticism. It is meant to be a kind of, you sure it's a very good idea that we were not going to paint ourselves into a corner.
Okay. What did you make of this? It was called the Central Financial Work Conference, held twice a decade. So it was designed to set the sort of financial oversight for the next 5 years. They were talking about resolving local government debt risks and expanding borrowing at the central government level. But I didn't see a lot of details about how exactly are they going to resolve all this debt. What are your thoughts on this meeting?
Yeah, I think, it's once in 5 years, right? So last meeting was in 2017. So even in that meeting, you see similar sort of wording regarding, some of the key areas with hidden financial risk, for example, the local government debt and also the property sector. And I think these two issues are related, right? So this time around, there seems to be more emphasis on how best to resolve the local government debt situation. So there's no surprise at all in this meeting. I think the wording seems to me is an extension from last meeting 5 years ago. And also, if you remember in 2017, right? So China emerged from the 5,000 point stock market bubble in 2016, trying to recover. And back then, even though the focus area were quite similar to this time around, which is the debt problem and also the real estate sector. But, China sort of, put on even more leverage in 2017, despite all the cautious wordings being used in that meeting. So, it's more important to me to see, how best they can resolve it. And as you said, Peter, there seems to be more sort of slogan chanting than actual details. And everybody knows that the local government's sector is laden with that, right? So, if you look at the PBOC survey, there's more than 70 trillion yuan worth of debt in a 120 trillion yuan economy. And I think the central government has about 30 trillion yuan worth of debt. So that is 100, and plus the private sector. So I think the leverage ratio for China in terms of debt to GDP is about 3.2, 3.5 times now. So it's very, very high, especially for an emerging market. So it remains to be seen. I think obviously there's a lot of work that needs to be done. The property sector, is still ailing. If you look at the numbers from October sales and also the new construction, property sector investment, et cetera, it's down 10%, more than 10% year on year. So it remains to be seen, what kind of details that can come out of it after the meeting.
I'm wondering what they mean when they use this word resolve government debt risks, because obviously there are losses and those losses aren't going to go away. So someone somewhere has to bear those losses. Who does the government think it should be? Does it think it should be the local governments? Does it think it should be the banks? Does it think maybe it should be the central government that bears the losses here? Who do they expect to actually bear these losses?
I think the central government has to take on more leverage. I mean, obviously, just now I mentioned that, right? So the central government only has about 30 trillion yuan worth of debt. So it's very little. If you compare across the world, regarding, for example, the federal government of the US and also the Japanese government, right? So obviously the central government of China is substantially under-leveraged in this equation. And I think that is because of the tax system set up, how the tax system set up and how the central government and the local government divided up the tax receipts from the provincial level, right? So the local government has to submit all the tax receipts to the central government, but then at the same time, they're responsible for local economic development. So they have to spend money on that. So as a result, the local government sell land to take the land sales proceeds and use it to build the local economies. So, in a way, it works tremendously well for the past 20 years, and China has registered phenomenal growth in the past 20 years. But then at the same time, that means that the local government doesn't have enough tax revenue to offset the spending they still have to do for the local economy. So I think as a result, you can see, there's a very skewed leverage ratio between the central government and the local government. So I think the local government has to step up. In terms of how best to resolve it. I would say that, for one, you can issue central government debt bonds to swap for the local government bonds to lower the borrowing ratio and the borrowing costs. And I think secondly, probably you have to approve new sort of type of tax for the local government to collect money from the local economy, namely the property tax that has been in discussion for like almost a decade now. Right? So they have to be able to generate enough tax receipt to pay off the existing debt and also to continue to build the local economies.
Andrew, what do you think? It sounds like when the government says resolve, it means basically transfer, doesn't it, from local governments to the central government, or maybe some of it anyway. Do you think that's the right way to do it?
It brought me memories during the Vietnam War when the American authorities will say that they are going to use anti-personnel devices instead of fragmentation bombs, and they will terminate contracts with extreme prejudice rather than assassination. So I have no idea when I hear the word resolve. I said, excuse me? Okay.
What does it mean?
Actually, the answer may very well be, I take a slightly different position here, is the fact that they said that they are going to increase a fiscal deficit from 3% to 3.8% may very well mean that the central government is going to have a much bigger role in resolving it, namely taking the loans over itself by simply expanding its own fiscal deficit.
Because the central government's the only place where there's still a clean balance sheet, isn't there? So
exactly. This is what that professor in Beijing actually more or less said. And they said, well, they're not resolving the problem at all. They're simply passing it on to somebody else.
Yeah.
Yeah, Peter, I just want to add to that. So, basically, if you look at the local government debt situation, right, so it's 70 trillion or more. But I think most people believe that the LGFVs, they're not going to default. And, because the central government would have to sort of back the local government to resolve all these debt issues. So I think, for most of us, we're just, looking for a sort of a structural change, between how you divided up the debt between the central and the local government people. But then as a result, there has to be a new structure to divide up the tax receipts between the central and the local government as well.
What do you make also how the other aspect of this meeting, which is the creation of a super regulator, which is going to oversee the financial system? It's going to oversee the People's Bank of China, the China Securities Regulatory Commission. In effect, it's really going to centralize control now over the financial system in the hands of President Xi. Is this a good idea?
Yeah, I think the idea has been sort of around for some time. There's a committee called Financial Stability Committee that sits on top of PBOC, CSRC, and the rest of the financial agencies. So it has already been set up. And also, this committee, reports strictly to the Central Finance Work Office, which is under the direct leadership of Mr. Xi. So I think as a result, it's a consolidation of regulatory power to the top. And back then, before this government restructuring, the State Council is the one who's responsible for, the PBOC and CSRC and all that. So those agencies reported to the State Council, which is under the leadership of the Premier, who will be, in charge of the Chinese economy. But I think right now, after all this reshuffling and everything, clearly the regulatory power is being consolidated and, reported to the President's office.
What do you think, Andrew? Is this the right way to do it? Basically centralising control of the financial system in the hands of the Communist Party, really, isn't it? And in the hands of President Xi? Yeah,
well, as I said, it's very consistent. So in other words, as Greg say, there is no surprise. I think, let's say, politically speaking, might not be such a fantastic idea because any unpleasant measures taken, such as, for example, forcing the local authorities to reduce and withdraw their own direct or indirect support of the property sector, would be blamed directly to the feet of the Communist Party. I'm not quite sure whether, I would want to take on a poison chalice the size of a very large swimming pool. Politically speaking, if I was there, I would say, let's spread the risk around rather than saying, we are going to be completely responsible, we being in the Communist Party. Well, that's a political decision rather than an economic decision. And also the notion that continuously the party has the technical knowledge and the technical expertise to take on solutions of what is primarily a technical problem will depend on how much the party is willing to listen to advice from, let's say, technocrats as opposed to their own advice. But having said that, number one, this is very consistent. Okay, in other words, this is not a critique. They're saying, good, look what the Communist Party is doing now. They've been doing this for a very long time, particularly under Xi. And the second point is the political fallout of this may very well end up at the feet of the Communist Party, which is something presumably that they have taken into account.
Okay. Hal, before we finish up, I want to get your thoughts on the local markets here. Although the Hang Seng didn't do much yesterday, it had a bad October. It was down, 2.9, sorry, it was down 3.9% in October. For the year to date, it's down about 13.5%, the worst performer among global indices. The Shanghai Composite not doing much better. It was down 2.9% in October, close to the lows of the year. It did drop below 3,000 a couple of weeks ago, rebounded back above that for now. But what are your thoughts on where we are and what it's going to look like going forward?
Very, very quickly, there are two things. First is, of course, is the interest rate situation in the United States, which is unresolved, which means as far as Hong Kong is concerned, high interest rates stay. And then we go away because we have zero control over that. So in other words, if one looks at the Hong Kong property market, one has to go and ask Mr. Powell what he tends to do. And the second point is the accumulation of evidence that property prices have been falling, and they had some of the worst declines, both cumulative and in terms of trend, for the last perhaps 10, if not 20 years. So the property sector ain't doing well. And if that's the case, there is no way that the Hang Seng can do also well. So taking the two things together, no change in interest rates, the property sector continues to get hit, therefore the Hang Seng index stays hit.
Hal, what are your thoughts?
Yeah, well, I think even though it's still weakish, there can be a technical bounce here. I think Andrew's right to point out that, because of the interest rate differential is still here, and therefore the pressure on the Hong Kong dollar and also on the Chinese yuan is still here, and therefore it's going to be a struggle for both the Hong Kong market and also the mainland market. But having said that, because the both markets have been sold down so aggressively. Just now, Peter, you mentioned that the foreign investors sold off the most in recent years, basically in October. So I would say that because the sentiment is so pessimistic, and we're probably moving to towards the better part of the seasonality of the year, and also if the Fed can pause from here, and also the U.S. markets continue to stage a rebound, Hong Kong can join in terms of a technical rebound. But I think going into next year, obviously, there's so many unknown variables that we discussed just now. It remains to be seen, how a sort of a technical bounce can sort of evolve into a more sustainable bounce. But otherwise, it will be a similar year as this year. You have a strong rebound initially, and then end up giving all the gain back plus more.
Everyone's so pessimistic on. Sorry, Andrew. Yep.
Sorry, very, very, very quickly. Also, the number of mortgages with negative equity in Hong Kong has been astronomical. I looked at the figures yesterday, and it is astounding. We're talking in tens of thousands, not in few hundreds, and also involving several billions of Hong Kong dollars of negative mortgages, negative equity mortgages. And again, this is another, let's say, symptom of an achy property market.
How when the sentiment is so bad, when valuations are so beaten up, that's normally a good time to buy, isn't it? So aren't you tempted, this period maybe turn out in hindsight to have been a very good buying opportunity?
Yeah, for trade, yes. I think around 17,000 points for the Hang Seng and 3,000 points for the Shanghai Composite seems to be the lower point of this trading cycle. So I think for traders, many of us, are itching to, put on our position for a technical rebound. especially now, the near-term U.S. interest rate uncertainties have been resolved, even though the longer-term outlook remains to be seen. So I would say that 17,000 for Hang Seng is a very reasonable level to trade for a rebound, and also 3,000 for the Shanghai Composite.
Okay, well, thank you both very much for your thoughts on what's been a busy day for business and finance news. You heard there Hao Hong, who is Chief Economist at Grow Investment Group, Andrew Freris, who is the CEO of Ecognosis Advisory. I'm joined now by Ross Feingold, who is Business Development Director at SafePro Group over in Taipei. Good morning, Ross.
Good morning.
Now, Foxconn says its current operations are normal and has called for confidence in the company after a tax probe, which was launched by Chinese authorities. Honhai is under tax and land investigations in several Chinese provinces. Ross, how much is this linked to the fact that Foxconn's founder, Terry Gou, is standing as as a candidate for president in Taiwan?
Well, that's certainly the common belief is that this is an expression of displeasure with Terry Gou's campaign. And the reason for that is, although Terry Gou, as far as what his proposed policies towards China would be, should he be elected the president here, is a policy that China would like. But the issue is it's splitting the opposition vote. So most polls show that the combined opposition vote is far ahead of what the DPP candidate, William Lai, the current vice president, would get. But with three opposition candidates, if you include Terry Gou, there's also the Nationalist Party candidate and the Taiwan People's Party candidate, it splits the opposition field. So the common view is China is angry about Mr. Gou. Instead of helping to support one opposition candidate, he's just splitting the vote. Now, on the other hand, this might just be the normal course of things. China sometimes does investigate foreign companies. That's been in the news a lot lately, including Taiwan companies. And it's also a way to send a message to Taiwan companies that we are going to investigate you periodically, as a way to show that we can. And it's not the first time that China has used this tactic against Taiwan companies. It's one of those tactics that China has to show its displeasure with Taiwan in general, just like military exercises or persuading a country to drop diplomatic relations with Taiwan are the other kinds of tools that China has to sometimes show its displeasure. But I think we have to take at face value when the company says operations are normal and they're going to cooperate with these probes. I think we take at face value and operations are probably normal.
I remember when he announced his intention to run for president, he basically said that China couldn't touch him or his company. In fact, if I quote him directly, he said at the time, if the Chinese Communist Party regime were to say, if you don't listen to me, I'll confiscate your assets from Foxconn, I would say, yes, please do it. I can't follow their orders. I won't be threatened. It sounds like, doesn't it, that Beijing's calling his bluff now?
Well, I don't think any of Mr. Gou's assets are at risk. He's a significant shareholder in the company, but they're not going to. China can't take his shares. The company, the company operates without his involvement anymore. He's not even on the board of directors. He resigned from that when he decided to run for president. So he's not involved in day-to-day operations. It's not clear what China could really confiscate. I mean, that was some grandstanding from Mr. Gou, I think, when people said, "Oh, but you were involved with a company for many years that has tremendous investments in China. How can we trust you?" So that was his kind of off-the-cuff remark, by way of saying he'll stand up to China if it becomes necessary.
So China can't do to Foxconn what it basically did to Alibaba and Jack Ma when Jack Ma challenged Beijing, and it really cut them down to size, didn't it? You don't think there's the same risk there?
Yeah, I don't think that's not really a plausible outcome for a Taiwan company as opposed to a mainland China company. And Mr. Gou is not in China right now, so at least he's not. His personal safety is not at risk either.
Now, on the election front itself, there's talk about two of the opposition candidates joining forces to try and avoid splitting the votes and giving the election to the DPP. What's the chances of that happening?
Well, there's been on again, off again negotiations between the Nationalist Party and the Taiwan People's Party, both for the presidential ticket as well as for legislators as well, so that they could stop the DPP from maintaining its majority in the legislature. But like I said, these have been off again, on again. There's been a lot of back and forth criticism between these two parties in the media about who is helping and who is hurting talks towards unity. But ultimately, they can't seem to agree on the key issue, which is who would be at the top of the ticket and who would be the vice presidential candidate. And if they can't agree on that, it's going to be pretty difficult for them to have any kind of joint ticket. Right? Obviously, somebody's got to give way. So either Ho Yo-i, who's the candidate for the Nationalist Party, or Ko En-je, who's the candidate for the Taiwan People's Party, one of them would have to say, okay, fine, I'll be the vice president, and I'll be number two, and we could win the election and live happily ever after. But until one of them is willing to give way on that, there won't be a unity ticket.
And how do you think their supporters would react to that? Because they sort of appeal to different sort of pools of voters, don't they? Is there the risk actually that if they were to join forces, they wouldn't at all reunite the voting? They might split them up even more.
Well, again, based on the polls that show a real ceiling for William Lai of the DPP, his support being around the mid-30s, and polls show that combined, the opposition would easily win the election. So the working assumption is that they could beat William Lai if they unite. It wouldn't cause too much of a bleed in votes back to William Lai, and you're correct. They do, the two parties, the Nationalist Party and the Taiwan People's Party, do appeal to somewhat different constituencies or voter blocks. But the hope is that all those voter blocks are united in one thing, which is to defeat the DPP after 8 years of a DPP president. So they got that going for them if they could overcome the major issue, which is who will be the president and who would be the vice president.
And of course, we shouldn't forget, as well as the presidential election, there is a parliamentary election as well, isn't there, for the legislator? What's the state of the polls for that?
It's very hard to poll legislative election because there's about 70 constituency seats, but then there's around 30 at-large seats, so it becomes very difficult to do effective polling. But again, the working assumption is if the opposition can unite, if they're not running against each other, and they could work out a deal where in certain constituencies they'd give way to the other party, that they had a good chance of throwing out the DPP's majority. And it doesn't look like the Nationalist Party, the Taiwan People's Party on their own could get a majority, but it does look like combined they might have a majority, and it would put the DPP into the minority. Well, one scenario to be concerned about, though, would be if combined, the DPP is a minority versus the Nationalist Party and the Taiwan People's Party, but there is a DPP president, and that would lead to some chaos and would make effective governance very, very difficult here.
Okay, so to change tack a bit, the Congressional Committee in the US that's looking into China, the Select Committee on the Chinese Communist Party, I think it's called, has written to the Treasury Secretary. It sounds like, from what they're saying, they really want the US Treasury to take a hard line, don't they, on sanctions against China?
Well, yeah, they recently issued a letter, and this has to do with President Biden's earlier directive that he's going to impose restrictions on venture capital or private equity investments in some key technological areas like AI or semiconductors. So the Treasury Department's supposed to be coming up with these rules or the specifics about how that order will be implemented. And the letter it was a bipartisan letter. It came from the chairman as well as the ranking member, the senior Democrat on the committee, basically reminding the Treasury, we're watching, you better issue some really strict regulations to implement President Biden's order. Then one thing that caught my eye in this letter is in the penultimate paragraph, they mentioned the public markets as well. And this is a distinction that sometimes gets lost in all the conversations about restricting U.S. investment in China or all the criticism. So there'll be critics in the U.S. will say, oh, you're funding Chinese companies that do X, Y, or Z. But they're sometimes pointing their criticism at asset managers, firms or a Hong Kong subsidiary of a U.S. firm that runs an asset management business that offers unit trusts, and the unit trusts might hold shares in certain Chinese companies, or might be an ETF that tracks the market. And the experts that are in your audience would see a great distinction between a private equity or a venture capital type of investment versus investments in the public markets. But the letter mentions public markets as well, and it basically signals that people in Congress are now watching that, and the critics are watching that as well. And they're going to come after U.S. investors who, through the public markets, like in Hong Kong or in Shanghai, are investing in Chinese tech companies or other types of Chinese companies that might have a role in national defense in China. So they're coming after that as well, whereas before maybe there was a lot more focus on private equity or venture capital style investments. But now directing money into the public markets to shares issued by certain Chinese companies, that's not going to be good anymore.
This will be a major step up, wouldn't it, of what the US is doing, because it's never gone that far, or never even suggested it wants to go that far in terms of stopping funds from investing in the public markets, just buying shares as part of an investment trust or a pension fund, or buying ETFs. They've never gone that far. It's hard to imagine the Treasury Department also agreeing to that.
Well, they could agree because the atmosphere, that's what the atmosphere is as far as quote unquote being tough on China. But sure, people in the audience are experts in this stuff. And your first reaction would be to say, you're nuts. How is an investment in the public markets propagating? I'm not handing money to the Chinese Communist Party or the central government by investing in the listed shares of a certain Chinese company. It's not putting cash into the hands of management. Although of course a healthy share price is always good for management, right? A healthy share price becomes currency to use in an acquisition, for example. But yeah, again, I can see where people in the audience are going to say that's nutty. But that just shows where the atmosphere is for being tough on China, that even investment in the public markets now is ripe for criticism by members of Congress.
Now, finally, before you go, tell me about Kurt Campbell. Looks like he's going to be nominated to be the Deputy Secretary of State. Now, he has some form when it comes to China, doesn't he?
Well, he's the so-called Asia czar at the National Security Council since the start of the Biden administration, and he's previously served in the Obama and Clinton administration. So he's somebody that people in the past would call an old China hand, that he's been around the Asia policy-making game for many, many decades. And when he's not been in government, he's been running a consulting business, helping companies navigate doing business in the Indo-Pacific region. So you can see on paper where he'd be a logical candidate for a senior level opening at the State Department, although he would no longer be focused only on Asia. It would be a global role. Frankly, I'm not sure why he would want to switch out of his Asia-focused role, even though on paper he's being nominated for a more senior and more prestigious position. But there might only be a year plus left in the Biden administration. And frankly, his confirmation is going to be difficult because there'll be a lot of Republican senators who are going to say you weren't tough enough on China during the time that you were the Asia czar for the Biden administration, or you didn't do enough to support allies like the Philippines, for example, with all its territorial disputes in the South China Sea, with China that's been in the news so much recently. So he's going to have a very difficult confirmation fight. It's not guaranteed that he'll pass through the Senate. I guess there's always a fallback. He could just stay in his current job, which is not a Senate confirmed job.
Okay, Ross, always good to talk to you. Thank you very much indeed. That's Ross Feingold, Business Development Director at SafePro Group over in Taiwan.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Frederick Chu, Managing Director at Magnum Research. And with a view from South Korea is Peter Kim, Managing Director and Investment Strategist at KB Securities in Seoul. Bye for now.
Money Talk